If you ask any personal finance creator what they invest in, most of them will say the same thing, the All-World ETF. But is this actually the right answer for everyone? Well, today I'm going to walk you through what it actually is, why so many people invest in it, the pros and the cons, which most people overlook. But before we get into it, just a quick note to say everything in this video is financial education, not financial advice, and your capital will always be at risk when you invest. So the All-World ETF tracks something called the FTSE All-World Index, which holds around 3,500 companies across 49 countries, which covers both developed markets and places like the UK, US, Japan and Germany, and emerging markets, which are places like India, China, Brazil and Taiwan. And the idea is very simple. You buy one fund and you own a slice of almost every major publicly listed company on earth. And the most popular version for UK investors is from Vanguard, and you'll typically see it listed under two tickers. So the VWRP, which is the accumulating version, meaning any dividend the fund receives get automatically reinvested on your behalf. VWRL, which is the distributing versions, are where your dividends get paid out in cash instead. They both track the same index and hold the exact same companies. The only difference is what happens to your dividends. And the cost of this fund is 0.22% per year, which means one fund is covering almost the entire investable world at a very low cost. And that's a big part of why it has become so popular. So the appeal is pretty straightforward. So most people don't want to be spending hours and hours researching individual companies, reading the earnings reports, or trying to figure out whether one sector is going to outperform the other. You just want your money working for you over a long period of time without it becoming a part-time job of where you're having to manage your investments. And the All-World ETF solves that. You own thousands of companies across the world in one go, and because it tracks an index rather than it being actively managed, it is essentially running itself. And there is a broader idea behind it that a lot of people find compelling, and it came from a book written by Andrew Craig called How to Own the World. And Andrew's argument is that the wealthiest and most sophisticated investors in the world have always owned multiple assets across multiple geographies. So they didn't try to predict which country would win or which sector would outperform. They just owned everything broadly and cheaply and let time do the work. And the long-term numbers suggest that approach has some merit. So historically, global equity markets have averaged somewhere in the region of 8 to 10% per annum over the long run. And since the Vanguard All-World ETF launched for UK investors back in 2012, the average annual return has been around 12%. That ETF has been running longer, but for UK investors. And over the last 5 years, £1,000 invested, again, which isn't anything to sniff at. And over the last 12 months, again, that fund has returned 28% roughly, which is extraordinary in investing terms, which means the case for the All-World ETF is a genuinely strong one. So now we've understood what it is, we need to look at what the pros of this ETF are. So firstly, it's the cost. 0.22% per year is a low annual cost, and over a long time horizon, that matters more than most people realize because you want your fees as low as possible. Second, it reduces the behavioral mistakes. So one of the most underappreciated things about owning an index fund is what it stops you from doing. So when there are no individual companies to pick, there are no individual companies to panic sell either. There's no sector to rotate into in exactly the wrong time, or no specific stock to chase. The fund removes those decisions, and by removing those decisions, you're removing the opportunity to get it wrong. Thirdly, it's quietly adapting to the world. So the FTSE All-World Index is not a fixed list of companies. It's constantly evolving. So businesses that grow will get added, and businesses that decline will get taken out of it. So over time, the fund is always reflecting the world's current largest publicly listed companies without you ever having to make the single call of adding or removing these companies. And the fourth one is, which I think the most underrated, is outsourcing your ego. So by buying a passive index fund, it's an act of intellectual humility. So you're essentially saying, I don't know which company, country or sector is going to win over the next 30 years, and I'm not going to pretend that I do. And for most people, that is a smarter position to be in than you're willing to admit. Well, so far we've covered what this fund is, why the case for it is genuinely compelling, but it wouldn't be fair to look at where this potentially falls short as well. So the first one is that you buy the All-World ETF thinking that you own the world, but almost 2/3 of your money is in one country, which is around 62 to 65% of it being in the United States. And of that, that, roughly 20 to 25% of the entire fund is in technology. So Apple, Microsoft, Nvidia, Alphabet, known as Google, Amazon, and Meta. And these are the companies that the media call the Magnificent Seven, and they account for around 24% of the MSCI World Index alone. So you've bought this fund for diversification, but nearly a quarter of your money is in 7 companies. And the second point is then over diversification, which I know sounds a bit contradictory, but people are buying this fund because it owns 3,500 companies, and that breadth is supposed to be the point. But that saying breadth means that you're not just owning the best companies in the world, you're also owning everything else. So the high growth businesses that are disrupting the sectors, but you're also invested in the slow declining ones, in the companies that have barely moved in years. And it all goes together and gets averaged out, which people want, but some people don't as well. And this leads us on to the next point. And it comes up a lot when people are comparing this fund to the S&P 500. And you need to think about it in the way that you're owning the same star players as anyone invested in the US focus funds like the S&P 500, of owning Apple, Microsoft, and Nvidia. They're all in there. But with the All-World ETF, you're also giving more playing time to thousands of other companies in other international markets. And if the US continues to outperform the rest of the world, like it has for much of the last decade, those extra holdings are going to weigh on your overall return, which means you're diluting your exposure to the companies that are actually winning. And this fund is only as powerful as the time that you give it. So it's not designed to be dipped in and dipped out of. It's designed to be held for a long period of time. So if there's any chance that you'll need that money in the next 3 to 5 years, then this might not be the right vehicle, because markets can, and they do, fall very sharply. So if you think about the pandemic that we had in 2020, the All-World ETF needs time to absorb that and then recover from it. So the longer your time horizon, the more this fund will work in your favor, but the shorter it is, there is a potential that you're carrying more risk without necessarily realizing it. And the next point is that it rewards patience more than it rewards conviction. So the All-World ETF does not give you an edge, and an edge is what happens when you identify something the market hasn't priced in yet. So it might be a company, a sector, or a trend, and that edge is what can generate returns that significantly outperform the market. But by design, this fund will always match the market minus the fee, so you'll never outperform it. And for a lot of people, that's exactly what you want. You want to take the average. So where does that leave us? Well, there's a lot to weigh up here, because the case for this fund is genuinely strong. It's low cost, it removes behavioral mistakes, and it adapts over time, and it also keeps your ego out of the equation. But it's worth knowing that Andrew's actual philosophy goes further than just owning a global equity fund. His argument is to own all assets across the world. So stocks, yes, but also gold, bond, property, commodities, which we can talk about in another video. And the All-World ETF is just equities only. So the version of owning the world that it describes is actually broader than what this singular fund gives you, which isn't a criticism, it's just knowing what it is and what it isn't. So one thing I want to be upfront about is I invest in the S&P 500, not the All-World ETF. And I think the debate between those two funds is often a lot more dramatic than it actually needs to be. So the All-World ETF is roughly 60 to 65% US, and the S&P 500 is 100% in the US. So you're not really choosing between America and the rest of the world, which a lot of people like to frame it as. You're choosing between mostly America and entirely America. And that's an important distinction that often gets lost in that conversation. So for me, the question comes down to this when you're looking at both of these funds. Do you believe the US will continue producing the world's most valuable companies over the next 20 to 40 years? If you think that is correct, the S&P 500 may be a more logical choice. But if you don't, or you simply don't want to make that decision, the All-World ETF may be a more neutral approach to take with your investing journey. And I think US companies certainly dominate for at least the next 5 years. So for now, I'm personally rather have my full exposure to the S&P 500 than spreading my money more thinly across markets where I'm less convinced by. But could that change? Absolutely. I'm not loyal to one fund or one country. If the investing landscape shifts, I will adapt to that. And people talk about China as the US's biggest economic rival. And maybe that's true in the size of economy, but investing isn't about owning the biggest economy, it's about owning great businesses. And those two things aren't always the same. And because I also also have a long investment horizon, which means I'm comfortable taking on a bit more concentration risk in pursuit of potentially higher returns. Whereas someone closer to a retirement age might make a different decision. And at the end of the day, either of those approaches aren't right or wrong. It comes down to your goals, your risk tolerance, and what you believe the future will look like, and adapting your investing to that. So the best investment is not the one that's necessarily performed the best in the past or what you think it is. It's the one that you understand, you believe in, and can stick with for the next however long you need to invest for, where you're not constantly second guessing yourself, so you can stick to the investing fundamentals that you've decided to put your money into. So to wrap this up, the All-World ETF is viewed as one of the most sensible long-term investment vehicles available to retail investors because it's low cost, globally diversified, and reduces behavioral mistakes. But it's not without its own trade-offs as well. And even though I don't own this fund, I can understand why people do. This video has been created to help you understand this fund better, and it isn't to say whether to buy it or not. And as always, nothing in this video is financial advice. Your capital will always be at risk when you invest, but if you found this useful, I have a newsletter where I go into topics like this in greater detail to help you take more control of your money. The link is in the description, and all I need is your best email address. But if you want to continue watching, YouTube recommends the video that's displaying here, here, or here. I never know where it is, it's just somewhere in this region, and I hope to see you on the next one. Thank you.